Okay, we're going to start on chapter 4, and some of this is review. The first part of it's going to be review from previous chapters. I'm not ready to give up. Move this now. All right, so we're going to first kind of just review on what the financial statements that we prepare are. So we did this in chapter 1. You first got the income statement that has revenues and expenses on it. Revenue goes first, expenses listed in order of size, largest to smallest, miscellaneous always last. And what's the answer you get on the income statement that you need to go to the next one? Net income. So you get your net income on this one, and it carries over to your statement of owner's equity. All right, then your statement of owner's equity reports changes in capital. And this is kind of the format. So you start with beginning capital, and then in the second column, the first column rather, you have these things that you had owner investments, net income, and you subtract owner withdrawals. And then the combination of those things gives you either an increase or decrease in owner's equity, and you add that to beginning to get ending. Y'all have done this. It's not really new. It's just review. Balance sheet. Remember, it's a formal presentation of the accounting equation. And you start with assets. You have liabilities and owner's equity, and the totals of liabilities and owner's equity and assets total should be the same. Okay, so one thing that we're going to kind of add on to the balance sheet in chapter 4 is we're going to be classifying some things on the balance sheet and like further breaking them down into different categories. Okay, so just kind of as a refresher, let's look at this first example, and I want y'all to tell me for each one of these accounts which financial statement it goes on. But first of all, tell me what kind of account it is. What is cash?
Asset.
It's an asset. So where does it go?
Balance sheet.
Balance sheet. All right, so remember, income statement is revenue and expenses. And your balance sheet's going to be assets equals liabilities plus owner's equity. All right, what about accounts payable?
Balance sheet.
Yeah, it goes on the balance sheet. What kind of account is it?
It's a liability.
It's a liability. What about fees earned?
The income statement.
Yeah, it goes on the income statement. What kind of account is it?
Revenue.
It is revenue. All right, what about supplies expense?
The income statement.
It goes on the income statement. What kind of account is it?
It's an expense.
That was pretty easy. It's pretty straightforward. What about equipment?
It's an asset, so it'll go on the balance sheet.
Is this making, like, are y'all getting these okay? Okay. What about the drawing account? It's drawing.
Equity.
Yeah, it goes on the statement of owner's equity. What about salaries expense? It's expense. So where would it go? Are you still swallowing? Oh, I skipped accumulated depreciation. Sorry. Where does that one go?
income statement?
Mm-mm.
That's not an expense.
It's a contra asset account. So it's gonna go, it has a credit balance, but it's gonna go with the assets. It's gonna go on the balance sheet. So it is a contra asset.
But it's still under assets. Is it?
Yes, it still goes under assets. Unearned fees. What kind of account is unearned fees?
Is that an asset?
Unearned fees. Yeah, it's unearned revenue. It's a liability. So where would it go?
On the balance sheet.
It's gonna go on the balance sheet. Salaries payable.
It's a liability.
Anything that you see payable by is gonna be a liability. Insurance expense. Where's it go? Supplies. That's my asset. Where does it go? All right, Emily Brown Capital, where would that go? Yeah, it can go in two places.
But also if you're on the balance sheet.
Yeah, it'll be on the balance sheet too, and it's owner's equity. What about depreciation expense?
Income statement.
It does go on the income statement. What, it's an expense. What about accounts receivable?
On the balance sheet.
Balance sheet, it's an asset. What about prepaid rent?
Is that also considered an asset?
It is an asset. And it goes on the balance sheet. Y'all all good with those? Make sense? Okay.
But you wouldn't do the for prepaid rent, you wouldn't do the rent expense until it expired, right?
Well, that's right, yeah. I don't know what's happening. So we're gonna kind of go through the motions and just do prepare some financial statements, just to refresh your memory on them. We've got some balances here taken from the adjusted trial balance for Laser Messenger Service. It's a delivery service firm, and the fiscal year, meaning the business year, is ending April 30th, 2019. So they don't have everything in order for us. We got to do it ourselves. So what will go on the top line? Yeah, Laser Messenger Service. Okay. Company name's always going to go on there. All right, what about the date?
For the year ended April 30th, 2019.
Yeah, because they're telling us it's for the year. So you know you're going to put for the year ended.
I basically wrote it out, you just removed this part.
Yeah, right. But if we were doing the balance sheet, it would just be
April 30th.
right. Okay, so we have got on here, what revenue accounts do you see?
Concerned.
Yeah, that's it. So we'll put that on here first. And it is $674,000. Okay, so next we're gonna put the heading expenses. And we're gonna list them in order of,
So we don't have to put that in revenue.
no, I mean, we're gonna have some problems later on where you have more than one revenue account, and in those cases you would. You put revenue, you list fees earned, you list rent revenue, and then you get total revenue. And then, move to expenses after that. But since there's just one, you don't have to do that. Okay, so what would our first expense be?
Salaries.
Yeah, you're gonna kind of find from here on out that salaries expense or wages expense gonna be your biggest expense on these problems, so. And that's true in reality as well. Okay, so that's 336,900. Okay, so what would be next?
Rent.
Okay, so we're doing them in order of largest to smallest. So rent expense is next. 60,000. So what's the next highest one?
Utilities.
Utilities expense. And that's 41.2. And then what's next?
Depreciation.
Yeah. Okay, what's next?
Supplies.
Supplies expense. $4,100. And what else? Insurance. And then what's left?
Miscellaneous.
Okay, so y'all tell me what my total expenses are. Remember, don't abbreviate our financial statements. Hold on, one ready. That's okay. Do what now?
456,000.
Okay, so that's your total expenses. All right, so now what do we do? Subtract. So what's my difference? $674,000 minus $456,000. 218,000. And what is that?
Net income.
Yep, net income. And you don't have to skip a line. I just. Okay. So that's what it looks like again. And then we're going to do this next one where you actually have a net loss. I don't think we've done one yet that shows a net loss. Okay. So on this one, we have revenue and expenses taken from the ledger, holistic health services, after adjustments, February 28, 2019, the end of the fiscal year. So on this top line above the words income statement, what do we put on there? Holistic health services. Bless you. Bless you. Okay, income statement, and then for the year ended, February 28, 2019. All right, so on the first line, what are we going to put up there? Now, this one's different because you don't have a fees earned. So which one? Service revenue. It's not always going to be fees earned. It may be called something else. It's still revenue, but they're just calling it something different. All right, so that's 448.4. Okay, and then we'll We don't have another one, do we? All right, so let's list your expenses real quick. What is the highest one?
Wages.
Wages. Okay, that is 360. Okay, what's next? Rent?
Rent.
Sound like you went, All right, how much is rent? 54. What's next? Utilities expense. $33.9. What's next? Yeah. $7,500. What's after that one? What was that?
Insurance.
Insurance. $3,000. And still got a couple more. Supplies expense. And then miscellaneous after that one. Okay, I'll go ahead and write it. Okay, so supplies expense, $27.50. And miscellaneous is $81.50. So we need to total them up. What's our total expenses? $469.3. Okay, so if we subtract expenses of $469.3 from revenue of $448.4, what do we get? Yeah, I mean, you can tell by looking at it that you're gonna have a loss. How much?
20,900.
I'll write this down.
Okay, no, it's okay. I'm trying to, I know what you're saying, but I'm trying to put it,
I got like this last money, so.
just trying to put it in the right order. All right, so that is our net loss. That's what it looks like when you have one. And you might say. In reality, you will. Okay, so that's just kind of a refresher. Wait a minute, I'm jumping into myself.
Oh, so I see the statement on there.
Getting too ahead of myself here. Okay, let's look at the statement of owner's equity. All right, in this example, we have Mary Hudson, who owns and operates Sparkle and Shine Janitorial Services. On January 1st, 18, she had capital of $468.5. So this is gonna be different. This is not like the ones we've done before where we had a brand new company and beginning capital was $0. They're telling us that her beginning capital is $468.5. So during the year, she invested $30 and withdrew $18.5. And for the year, for the entire year, she reported net income of $37,860. So we need to prepare a statement of owner's equity for the year ending December 31. So on the first line, we put the name of the business. It's always going to be the name of the business, not the owner's name. I have seen that before as a mistake on tests and things like that.
Is it saying real name?
No, I've seen mistakes made on tests where, you know, the student put the owner's name instead of the company name. Okay, so what are we putting on here next?
Statement of owner's equity.
Statement of owner's equity. Okay, and the date would look like okay, for the year ended December 31, 2018. I'm really tongue-tied all day. Okay, so on the first line, we're gonna say Mary Hudson Capital. January 1. And that will go over here. So her beginning capital was 468.5. What's the next thing we're going to put on here? Yeah. We'll put owner investments. And how much was that for the year?
30,000.
30,000. I mean, they're just giving us everything. We don't even have to look anything up. Okay, so what's going to show up next?
Kind of withdrawals.
That'll go here. So you will have owner withdrawals on here. That comes last. So let's put net income second. Okay, well. All right, so your net income was how much?
37,860.
37,860. How much were our withdrawals?
18,500.
What do I need to do to show that this is a parentheses around it? Because these other ones are additions. All right, so let's combine those three numbers. Yeah, tell me what you get. Excuse me.
$49,360.
Okay. So what are we going to call that? What's the label we'll put over there? What? No, you got part of it right. So I just can't hear you. You got part of it right. Did you say owner's equity?
Yeah, owner's equity.
It's increase in owner's equity. So the combination of these three things resulted in a positive number, so it'd be an increase in owner's equity. If it had been a negative number, it would have been a decrease in owner's equity. So now we'll add that 49,360 to 468.5, and what do we get?
$517,860.
Okay, and that's Mary Hudson Capital, December 31. Okay. I really prefer like doing all three of them in one company, but so y'all can see how it flows through. All right, so the thing we're learning today about the balance sheet is these classifications. Because what we've done so far is just kind of general classifications, assets, liabilities, owner's equity. But when you have a variety of different kinds of assets, we're gonna categorize them to separate them. So the first one is current assets. So current assets are any asset that will be converted to cash or used up in a year or less. So some of those are accounts receivable, supplies, prepaid expenses like insurance or rent. We've got on here notes receivable. Those would have to be short-term notes. And the book talks about customers making an agreement with, the company if they maybe can't pay their account off in 1 month or something like that, they'll make a deal with them to make payments on it. And so that would turn it into a note. If you're making payments on something and you've got an agreement about how much you're gonna pay and when, that becomes a note. So, when they convert their accounts receivable account to a note, then you've got a note receivable, and if it's payable within 1 year, it's short term. Does that make sense? There's not really, you're gonna see we're gonna have long-term liabilities. There is no such thing, it's not called long-term assets. You've got current assets, you've got property, plant, equipment, that's your fixed assets. I think I told y'all last chapter that it could be called 3 different things. It could be called 3 different things. And that's like your equipment, machinery, building, land, stuff like that. But we're calling them fixed assets, not long-term assets. And there's even additional assets that don't fit into either one of these 2 categories, and we would call those other assets. But I don't even know if we get into that in this class. So just kind of giving you that hint for now. There's no long-term assets category. Now these are long life assets, but they're not called that. So property, plant, and equipment, that's assets that are useful for a year or more. They're reported below current assets. They depreciate over time, except for land. So we're going to have an accumulated, if we had all of these on here, we'd have accumulated depreciation account for every one of them but land. That's not my preferred way of doing it, but that's just the way the book teaches you. So I prefer having one accumulated depreciation account for everything because I just believe it's cleaner. But anyway, so just get ready to see a bunch of those. All right, then on liabilities, we also have current liabilities. Those are debts due in a year or less. Accounts payable, generally, you're gonna pay off within a couple of months max. Wages payable, that's just when you have a break at the end of the month, ends in the middle of a pay period, so it's gonna get paid pretty quick within a couple of days. Interest payable, that's gonna be interest on a loan or something like that, and you're generally gonna pay that within a month or so. It'd definitely be within a year. Unearned revenue, if you have a customer that's paying you more than a year in advance for something you're supposed to do, they're probably not very smart. I mean, you're not gonna, as a company, pay for something that you're not gonna get for a year or more. That's just not smart. Somebody can run off with your money. Taxes payable. Taxes generally gonna be due in a year or less. And then notes payable. You got 2 parts to notes payable. When you owe money, like who has a car note? You're the only one here that's got a car note that you pay. So when you have a car note, I mean, generally, it used to be the most they would finance you for is 5 years. Now it's getting to be 6 and 7.
Mine's 4 years. I was not on that.
Well, okay, so how much longer you got to pay on it?
I paid on a year, so I got 3 years.
Okay, so whatever you owe in the next 12 months, those payments are current. But any payments you owe beyond 12 months, those are long-term. That part of your loan is long-term. But the part of your loan that is due, and I'm talking about the part of your loan that's principal, because when you make your loan payments, your car payments, unless you've got a 0% interest loan, then you're going to pay some on the loan and some interest. Well, the part that's the loan for the next 12 months, that's short-term. The rest of it's long-term because it's beyond a year. So notes payable could be, some of it could be short-term, some of it could be long-term. You could have the notes split, and you will. I mean, if you've got a company that's got loans, you're going to have their notes split between the short-term and the long-term portion. Okay. You're probably not even going to see most of the stuff, especially the long-term part, but just to let you know, if I'm thinking about a loan and some of it, they're not usually going to be for a year, they're going to be for more, especially if you've got a car loan. I just wanted y'all to know how it would be shown. All right, so long-term liabilities are not going to be due for over a year. So they're going to be reported under current liabilities, and you might have, like I said, a note payable like a car note, whatever's due after a year, and a mortgage. So a mortgage is gonna be more on like a building. Like this building here, if we were a company and we built our office building and we got a loan on it, that loan is secured by this asset. It's a mortgage. Technically, a mortgage is any loan secured by an asset, so I guess our car loans could be mortgages. But when you hear the word mortgage, it's normally going to be associated with a building or a property of some sort, land. All right, owner's equity, that's not changing. So, but it's still present, so I just listed it there because I had the other ones. All right, so what I want to do on this exercise is just classify these things as current asset, property, plant, and equipment, current liability, long-term liability, or owner's equity, just to kind of get you used to the idea. All right, so the following accounts appear on the adjusted trial balance of Brooklyn Accounting Services. Indicate the section of the balance sheet where each account would be reported. Prepaid insurance, where would that be? And if you need to look back at your previous page, there's examples listed, so.
Is that a current asset?
It's a current asset. First of all, I mean, if you need to identify it as an asset, then it's a current asset because if you pay more than 1 year's worth of insurance ahead of time, you're probably not using your money very wisely. Okay, accounts payable. What kind of account is accounts payable? It's a liability. How fast are you gonna pay it?
Pretty quickly.
Yeah, so it's gonna be a current liability. All right, what about land? It's an asset.
I was gonna say fixed asset.
Yeah. I mean, generally it's an asset, but which category would it fall under? Property, plant, and equipment. I've got to look that back up again and see why we throw the word plant in there.
Well, power plant.
Did you look it up by chance?
No, I would just assume because.
That's kind of what I was assuming too, and I think I was right, but it's just, people don't really call them plants anymore, do they?
They used to be called
Paper
manufacturing
plant.
plants.
I guess you still hear that.
Like a lot of industrial processes to do things.
Yeah, I guess I'm thinking of it being an old term. Okay, so if you have a note receivable and it's due in 1 year.
Current liability.
Receivable.
Oh, receivable.
So it's a receivable, so that would be an asset. And if it's due within 1 year, it's gonna be current. What about equipment?
It's a current asset.
It's an asset.
I don't think it's applies. Yeah, it's a current or a fixed asset.
It's a, yeah, it's a B. Okay, what about Stan Brooklyn Capital? It's equity. All right, accumulated depreciation building. That's gonna go with all your other assets in that category. With your assets in that category, not other assets.
Property, plant, and equipment.
It's gonna go in property, plant, and equipment because it's gonna show up just below the asset that it's related to. All right, what about salaries payable? It's a current liability. What about a note payable due in 5 years? That's long term. What about a building? Property, plant, and equipment. Taxes payable?
Current liability.
That's gonna be current. They're generally gonna be due in a year or less. What about supplies?
Current
Current
asset.
asset. What about unearned fees? Current liability. Cash,
Current asset.
accounts receivable, prepaid rent.
Current asset.
Okay. So now you're kind of familiar with those. All right, so preparing a classified balance sheet. We have some accounts and balances listed here, and these are for Elite Fitness. They offer personal nutrition consultation along with physical fitness training. After all of the accounts have been adjusted for December 31, the balances of the balance sheet accounts from the ledger are as follows. Okay, and remember, in chapter 1, we didn't know about adjusting entries yet, so we just took numbers and prepared financials. And, we would assume that they were adjusted. Now that we've learned the process, the financial statements are gonna be done after the adjustments are posted. Because we need to make sure the numbers are right. We're not gonna prepare financials that, have unadjusted numbers on them. Okay, so on the top line, what are we gonna put?
Elite Fitness.
Elite Fitness. What is the date?
December 31st, 2019.
Okay, so the first thing we're gonna do, we're gonna have our assets section, so we'll put our assets heading up here. But then we're gonna further classify by putting current assets. That's our subcategory. You could also put assets in the middle if you wanted to. There's different ways of, either one would be fine, but you often will see it in the middle because you got these subcategories. It just looks neater. It's up to you. It's not really, I'm not going to get bent out of shape either way. Okay, so remember, we're going to want to list these current assets in order of liquidity. That's not changing. So what would my first asset be? Cash. Okay, this is where it gets tricky. And if you were doing one of these for a test, I'm not going to get too wrapped around the axle by putting stuff in the correct column. But we're not going to use this one until we get into the property, plant, equipment. So we'll use this middle one when we have several items in a category that we're going to add together for a total. So we're going to put cash here. Okay, so what would be next? Probably be smart when you're doing these to check off the ones you want. What's next?
Suppliers.
No, there's something that goes before that.
So
Accounts receivable. Okay, so that's 15,425. Okay, so what would be next?
supplies.
Supplies, 6,200. What's next?
One of the prepaids.
Yeah, one of the prepaids. It really doesn't matter which one. I don't think one would necessarily be easier to collect than the other. So prepaid insurance and prepaid rent, if you were trying to get your money back, is what I'm saying. Because when you're thinking about the order of liquidity, I'm thinking about how fast can you turn this into cash? Well, you'd have to ask for a refund if you were going to turn either one of these into cash. So I don't think one would necessarily be easier than another to get a refund out of. So we'll just list them both. Okay, so is there anything else? Are we done with current assets? Okay, so let's total those up and we'll say total current assets.
$91,650.
Everybody agree? 91,650. All right, so the next category, subcategory, is going to be property, plant, and equipment.
So you have to write that out. Not like fixed assets.
No. No, you have to write property, plant, and equipment. You probably could. It'd probably be all right, but that's more proper. It's really kind of funny to me because it's wordy and long. All right, so what do we want to list first? Let's list land first. Because we're not going to depreciate it. We're going to put it in the middle. And you'll see why in a second. Okay, so the next thing, let's see. Well, we only have one other thing. So we'll put equipment. Now this is where it goes here. And then right underneath it, we're going to list accumulated depreciation equipment. Okay, and we'll put parentheses around it. 75.3. So what is the net of these two?
We can do the abbreviation.
Not on the financial statements. You can on your paper. I mean, I don't care what you do on your notes, but just write it out when you're on a test. You can do it in your journal entries, just not your financial statements. So what's the net of these two? And you're going to put it on the same line as the accumulated depreciation.
269.
169.7 maybe? 191.7? Okay, because now we're going to add those two together to get total property, plant, equipment. Now, what would this number be called? The difference between your cost and your accumulated?
Your book value.
Net, but your net is its book value, net book value. All right, so this is total.
That's what I did on accident. That's what I got.
What's that?
269,700
Gotcha.
on the total.
Okay, what's the total of 78 and 191.7?
269,700.
Oh, that's what you did. Okay, I gotcha. 269.7. Okay, and that's all of our assets. So we'll add these two together to get our total assets.
$361,350.
361,350. Okay, and we're out of time, so that's where we'll stop. And we'll pick that up on Friday. Hang on to these sheets because you're going to need them. I'll have that net solutions thing printed out for, I don't know, thinking next week, but y'all will be back till Wednesday. So it's in your module. If you will print it out, or you can come back and grab a copy from me as soon as I can figure out which computer and which printer are going to talk to each other today. And I'll give you a hard copy of it. Do y'all have access to printers? Everybody who does not have an access to printers.
That's why I put it here.
You know? Are you going to be in this building?